In this lesson, we're going to turn back to the income statement and focus on a very important number to shareholders, earnings per share. Turn on any financial news channel and within 5 minutes, you'll hear it. The company reported higher EPS than predicted, or earnings came in at $2.10 a share. In this lesson, we'll learn what that number actually is and how to calculate it. To understand what EPS is, imagine you own 100 shares of stock in a popular company. You turn on the news and you hear that the company's earnings were $500 million this year. Is that good for you? It sounds pretty good. $500 million sounds like a lot of money. As an owner of the company, you have a claim to some of that money. Maybe they even announced that this year's earnings is more than last year's. Also good, because increases in earnings are usually followed by increases in stock price, which means your 100 shares are probably more valuable than when you bought them. But you can't really answer the question because you don't know how many other shareholders there are just like you. You don't know how many ways that pie gets sliced. If the company has 10 million shares outstanding, each share's slice of the earnings is $50. Phenomenal. If it has 5 billion shares outstanding, each slice is only a dime. That's the entire point of earnings per share. It converts total income, which is impossible to compare across companies, into income per slice of ownership, which is comparable everywhere. It's the great equalizer of the income statement, and it's the denominator of the most quoted valuation metric on earth, the price to earnings ratio. Basic earnings per share is a fraction, and each half has one wrinkle. The numerator is net income minus preferred dividends. Why subtract preferred dividends? Well, because the bulk of a company's ownership usually belongs to common shareholders, sometimes all of it. But if there are any preferred shareholders and the company declares a dividend, they would get paid first, which is why we call them preferred. They get preference. One detail worth noting, preferred stock can be cumulative or non-cumulative. Cumulative simply means that the preferred shareholders are entitled to a dividend every year, even if the company doesn't declare a dividend. They just might have to wait for it. If the company doesn't declare a dividend for 2 years in a row and then finally declares one in year 3, they owe the preferred shareholders 3 years worth of dividends. It accumulates. This is what I want you to memorize for calculating EPS. If the preferred stock is cumulative, we subtract the current year's dividend whether or not one was declared. That claim accumulates no matter what, and its income is not available to common shareholders. If it's non-cumulative, we only subtract dividends that were actually declared. Okay, moving on to the denominator. By the title, earnings per share, you can probably tell that the denominator is the number of shares outstanding. But we can't simply use the shares outstanding at the end of the year. If half the shares were only outstanding for half the year, those shareholders wouldn't be entitled to income that was earned before that. Instead, we're going to use a weighted average of the shares outstanding during the year. This requires a bit of calculation because we have to consider dates and how long shares were outstanding to come up with a number that's representative of the entire year. This calculation is where we're going to spend most of our energy. Here's the way I want you to think about the denominator. A share of stock earns its spot in the calculation by being outstanding, by representing capital that the company had available to generate this year's income. A share issued on January 1st was on the job all 12 months. A share issued on October 1st only worked for the last 3 months of the year. It shouldn't get full credit. So every block of shares gets weighted by the fraction of the year it was outstanding. Shares issued on October 1st count at 3/12. So 100,000 shares issued on October 1st. Weight it by 3/12 to get 25,000. 100,000 shares outstanding for 3 months is basically the same thing as saying 25,000 shares were outstanding for 12 months. Treasury shares work the same way in reverse. When the company buys back shares, those shares stop being outstanding. So they enter the table as a negative number, also weighted for the months that they were gone. New issues add, buybacks subtract, and everything gets multiplied by months outstanding over 12. Now for the wrinkle that causes the most confusion, stock splits and stock dividends. First, understand why they're different from a real share issuance. When a company issues shares for cash, new capital comes in. There's a real economic event. But in a 2-for-1 split or a 15% stock dividend, no money changes hands at all. The pie is unchanged. It's simply cut into more slices. So we don't time weight a split like an issuance. Instead, the split gets applied retroactively to every share that existed before it, as if those shares had always been the post-split count. Here's how I want you to handle it, and I'm going to show you an example, but you're going to work down our table date by date, and when you reach a split or a stock dividend, I want you to stop and subtotal it. Add up all the equivalent shares that you've calculated above that line, and then multiply the subtotal by the split factor. So 2-for-1 split times 2, times 1.15 for a 15% stock dividend. Then keep going with the transactions that come after with no adjustment to them at all. They happened in the post-split world. One honest disclosure, most textbooks, including ours, teach this differently. They tack a retroactive adjustment factor onto each individual line above the split. Mathematically, it's the exact same answer, but it can be really confusing to look at, and in my experience, invites mistakes, especially with multiple splits. So I recommend subtotal, multiply, move on. If you see an explanation from a textbook or other resource that shows factors on individual rows, don't panic. The answers will be the same. All right, let's work through a few examples. In part A, we're going to learn how to calculate weighted average shares with multiple issuances, a treasury stock repurchase, and a stock split. Part B adds a 15% stock dividend and treasury shares that get reissued. And in part C, we'll look at a split and a stock dividend in the same year. We'll work down the dates, subtotal before each split or dividend, multiply, and keep moving. Let's start with Bootstrap Company, who had 0 shares of stock outstanding on January 1st. So I'm just going to plug in 0 here to show you how we would work this through. And I've already set up the formatting, but normally you would have to do this yourself. So we would multiply the number of shares by the months outstanding over 12. Obviously that comes out to 0. So on February 28th, when we have an additional issuance of 50,000 shares, then those are outstanding for 10 months. We'll actually get a weighting here. So saying that 50,000 shares were outstanding for 10 months out of the year is the same thing as saying that 41,667 shares were outstanding for 12 months of the year. Now it's April 1st and we've reacquired shares. So we need to put this in as a negative number. Those are no longer outstanding, and those were not outstanding for 9 months of the year. So we'll weight that over 12. And now we've got on September 1st a stock split. And you'll remember that whenever there's a stock split or a stock dividend, all you need to do is subtotal so that you can retroactively apply that stock split. We're basically assuming that all of the shares that were outstanding at the beginning of the year on February 28th and the ones that were repurchased on April 1st were also effectively split, right? So all I'm going to do is subtotal the number of shares that I've got outstanding here, and then on September 1st, apply my 2-for-1 split. So I can just multiply this by 2. Then on October 1st, we've got some additional shares issued, 20,000 to be exact, and those were outstanding for 3 months of the year. I'll weight those 3 over 12. And then I need to add this up, sum this up, but notice that I've already counted that subtotal when I doubled it here. So I only want to go this far, add these up, otherwise I'd be double counting the same shares that I've accounted for already in the split. So my weighted average shares outstanding is 76,333. That's what I would use in my denominator of basic earnings per share. Next, we're going to look at the same company, except this time they're going to have a stock dividend that was issued. So on January 1st, they also started out with some shares. They've got 60,000 outstanding for all 12 months of the year. We don't need to weight these, but just to make sure that we're showing all of our steps, we'll go ahead and do that. So 60,000 weights to 60,000, outstanding for all 12 months. Now on May 1st, we repurchased some shares. So those are a negative number, and those were not outstanding for 8 months out of the year. So I'm going to multiply that out over 12. And then on June 15th, we've got a stock dividend. So whenever we have a stock dividend or a split, we subtotal, because we're going to assume that all of these shares that were outstanding for the earlier parts of the year are the shares that would have this additional 15% of shares added to that. So I'll call this a stock dividend here. And all I do is take that subtotal and multiply it by 1.15 for the additional 15%. Now on August 1st, we also reissued our treasury stock. So we account for this and calculate this the same exact way that we would a regular issuance. And they were outstanding for 5 months of the year. And then on October 1st, we issued another 3,000 shares. Those were outstanding for 3 months of the year. Then we add those up all the way to our stock dividend. Don't include the subtotal or you'll double count it, and we get 68,000 shares outstanding. Last one, let's look at Renegade Corporation, who on January 1st, and let's add our date column here. On January 1st, they had 318,000 shares outstanding. And the months is 12, and the equivalent shares would go here. So that times 12 over 12 And then on July 1st, they issue another 22,000 shares. So those were outstanding for 6 months. Last one here, we've got Renegade Corporation, who has 318,000 shares outstanding on January 1st for 12 months. So for the sake of being consistent, we'll go ahead and work that out. Then on July 1st, they issue an additional 22,000 shares. Those were outstanding for 6 months. We'll weight those. And then we've got a 2-for-1 split. So we need to subtotal this before we apply our split so that we can consider that split as effectively being all of those shares that were outstanding since the beginning of the year being split into 2. And we'll just multiply our subtotal by 2, and that has already been weighted, so we can easily work it into our formula that way. So October 1st, then we issued common stock for cash. Those were outstanding for 3 months. Then on November 1st, we purchased some treasury stock. We need a negative number here. Those were not outstanding for 2 months. Then we have a stock dividend, so we need another subtotal. And we'll sum up everything from the 658. Anything earlier than that, we'd be double counting. And November 30th, we apply our 15% dividend, 15%. And I can just take that and multiply it by 1.15 to get that weighting. Then finally, we have one last issuance, and this is stock options that were exercised. It says it was a 2-to-1 conversion, meaning that each stock option could be exercised to purchase 2 shares of common stock. So new shares outstanding, if all of those are exercised, it's actually 20,000, and they were only outstanding for 1 month of the year. Now we can add up our numbers here to get our weighted average shares outstanding to be included in our calculation. Now we're ready to put the pieces together and calculate basic earnings per share. Remember our formula: net income less cumulative preferred dividends over weighted average shares outstanding. Let's revisit Bootstrap Company from part B of our first exercise, and we've been given some information. We've already got net income, and we also need preferred dividends. We've got the preferred shares outstanding of 5,000, and we also have the par value, so that's how much our shares are worth in dollars. And to get the preferred stock dividend, we just multiply this by 0.06. Then we've got our weighted average shares outstanding given to us, and we can calculate our basic earnings per share with our numerator of net income less the amount of preferred dividends that will go to the preferred shareholders is not available to the common shareholders, so shouldn't be in this calculation, and divide that by 68,000 to get our basic earnings per share of 4.56. To wrap up, EPS converts net income into a number that is meaningful to an individual shareholder and allows for comparison across years, companies, and industries, which is why it's the most quoted number in finance. The numerator is net income minus preferred dividends, and the denominator weights every share issuance by the months it was outstanding over 12. Stock splits and stock dividends are treated differently than a new issuance because no new capital comes in the door. We assume that they were outstanding since the beginning of the year.